Thanks, David, very much. Just a couple things. He's from Vegas, and did you see those flashing lights on the last slide there? So I thought that was really suitable. I thought that really fit in nicely. I want to just acknowledge a couple things. I'd like to thank Sierra Nevada College for hosting the event with us tonight. We really appreciate their involvement. In fact, I'm pleased to see some of my students have come. I am actually also an adjunct professor here at Sierra Nevada College. I teach an investment class. And believe it or not, what do you guys learn? 3 things this semester? Or we have to set 7 or 8. Yeah, that's right. So I usually guarantee that 3, and we usually, if we exceed 3, then they get their money's worth. So that's the plan. Tonight, hopefully I can do that with this group as well, cover a few topics that you may or may not have seen before, and go from there. All right, so really the topic is diversification. That's sort of the theme throughout the presentation. I'm going to be talking about why diversification matters, why it makes sense, and the types of diversification. So just keep that in mind as we go through this. Most investors today own real estate and equities, and the lesson from owning just those two is really important it could be really important going forward. And let's see if this actually does. There, I just had to press hard. My background, I've been in the investment business for years. I am the CEO of Incline Investment Management, a firm I started about 6 years ago. It took us about 2 years of research to actually build the strategies, and we've been running the strategy now for over 4.5 years. I am registered federally with the National Futures Association as a result of our business. I mentioned I am teaching here at SNC. I was full-time faculty a few years back and really enjoyed the teaching thing, so I do it sort of on the side because believe it or not, I actually really like it. I did work across the street briefly for Zazzle Associates, the big convertible bond shop here in town during the crisis. That was an enlightening moment for me and really led me to what I'm doing now. I did spend a number of years in Florida working for a guy named John Henry, who's better known on the East Coast, primarily today for his hobby. He was one of the original alternative hedge fund guys and one of the original CTAs, as they're known, commodity trading advisors. John is best known for his hobby, which is baseball. Does anybody recognize the name? On the West Coast, it's not so well known. He happens to own a baseball team called the Boston Red Sox. And John, I helped John make a ton of money over the years, and we had a really good run. And what we've built, we think, is even better than anything John ever ran. And I've been in the business for, the rest of that is just saying I've been in the business for a long time. Our firm, just briefly, tonight is not to talk about us, but I just wanted to just give you some background. We have a 5-person team. 2 of my colleagues are here tonight. I've got Corey Johnson standing in the back. You might have met Corey when you checked in. Corey is a somewhat recent, I guess, graduated from Sierra Nevada College. He's one of my top students. And he ended up coming to work with us and has been a fantastic addition to the team. We have Brian Duffy here in the second row. Brian is formerly of Natixis and has a lot of experience in distribution, and he is based in Oakland. We built a strategy called the Systematic Hybrid. We run futures and equities all systematically, which is a fancy way of saying we have quantitative algorithms to determine what our investment strategies are, and that's what we do. We're based now in Crystal Bay, and we are federally registered. Transitioning now to what the world looks like. What are we seeing? What's happening? And does anyone really have a better crystal ball than anyone else? There's a lot going on in the world, and so the bottom bullet is the U.S. election. Just besides all that, there's still a lot going on. We've got the ECB, the European Central Bank. We've got Brexit. We've got the Middle East. The Middle East never seems to go away, does it? We've got Brazil, Russia, India, all these competing factors. China, we still have a massive trade deficit with China, around, 4-1, I think it is. And the Fed, what's going to happen with the Fed now that the election has finally been resolved? Well, the bullet there is we're out of bullets. And so are we going to continue seeing quantitative easing going forward? No one's sure. Actually, and then the last bullet, no one's sure because of the result of the recent election. We really don't know what's going to come, I would suggest. So does anyone really know? And what do we do about it? And that's really what I'd like to sort of address. So to start talking about alternative investments, you can see from this slide, there is a great deal of choice. most investors have exposure to the traditional investments, stocks, bonds, and cash. And that's been the classic approach for years. And more recently, a number of studies have shown that having exposure to different types of investments makes sense because of the correlation, because of the difference in risk, and the return profiles, whether that's they perform differently at different times, etc. But these are sort of an overview of the different types of alternative investments. We're going to focus primarily on the second one, called managed futures. That is our area of expertise, and I'm going to demonstrate why it could make sense. Just before I get into that, I wanted to just briefly touch on there's sort of two types of investment managers out there. There's what I would consider to be more of the traditional approach, the investment managers that look at balance sheets, they analyze the company that they're choosing to invest, and they figure out, okay, this is how we're going to do it. There's value here. We're going to place an investment. There are systematic managers like ourselves, where we build quantitative systems, we build the algorithms to identify the opportunities in the markets. And the net result is they call us trend followers, and the reason for that is because we follow the markets rather than fight them. We don't know the direction of the markets. So if you don't know something, it's very prudent to actually follow direction rather than to try and pretend you know and pretend that you have a better crystal ball than the next guy. So it's just a different philosophy in net investing. The benefits of that, ultimately, is diversification and having low correlation to those traditional investments that most investors own. And that's ultimately what is the net benefit. The reason for that is that you're gaining exposure to markets and opportunities you typically wouldn't have in a normal portfolio. Under modern portfolio theory, which we have spent quite a bit of time in class covering, CAPM and some of the theories that go along with that support this, is that if you add a non-correlated investment to a portfolio, you actually have the opportunity to increase your overall portfolio performance and decrease your overall portfolio risk. Every investor wants to do that, or should want to, and may not realize. When they go to their broker, they're going to get the classic 60-40 model. And there's reasons for that. If you go, I'm not going to mention any big brokerage names, but they're all primarily based in New York, and you'll get that same response. Some of you have accounts at those firms, and they're recommending the old classic 60% stocks, 40% bonds, right? They do that primarily to cover their own liability, or whatever you think of in that sense. They have to cover themselves, and they don't want to take any risk. And they're certainly not recommending for you to take any risk, because they think of risk as being a bad thing. The word risk has negative connotations. But every type of investment has a certain level of risk associated with it. So if you're adding an asset that actually has a certain level of risk, but it's completely different than everything you own, you actually add value to your portfolio. And that's slightly counterintuitive to many investors. The endowments, in particular Yale, under Dr. Swenson, figured out early on that this non-correlation under modern portfolio theory made a lot of sense. And he went to a 50% allocation to alternatives. And they've, for years, been the leading endowment in a number of ways, and primarily in performance. I call that sort of modern diversification. And having an understanding that having that non-correlated diversification makes sense, Yale was one of the first to figure it out. A classic example of not being sufficiently diversified was in the most recent crisis. Classic case here in Incline. Investors thought, hey, I've got my equity portfolio, I own my house or my second house in Incline, and I'm diversified. I'm good. But let me take you back to your, I want to say grade 10 statistics, but I translate for the audience. It's actually 10th grade statistics, okay? You might have picked up on my accent. I'm not originally from here. So anyway, the fact is, if you go back to your 10th grade statistics, you will remember your correlation, right? Positive correlation is when everything moves together. There's a direct relationship. Negative correlation is when things move in opposite rates. Can anyone think of a negative correlated relationship? There's a classic investment example. Anybody think of that? Dave, you want to help me out here? Bonds and interest rates, maybe? Oh, stocks and bonds typically too, right? I think sort of interest rates and bonds. Interest rates go up, bonds prices will go down, right? Or vice versa. That's negative correlation. But what we're talking about is non-correlation. And that means there is no relationship. You can't find, there's no rhyme or reason why it's behaving the way it is. That's what you're ultimately seeking, is non-correlated assets when you're considering adding an asset to your portfolio. Investors learned the hard way in the crisis, when they saw their real estate and equities portfolios crash together. Remember, positive correlation can still be a really terrible thing on the downside. Because there's that positive correlation as they headed south. Not good for many investors. So, people, have they learned? I don't know. But part of that is, part of the purpose tonight is to bring awareness to the fact that there are other alternatives. Pun intended, I guess. What options do investors have, and what should asset allocation look like? Here's just a quick view, Harvard Management Company, of the evolution of asset allocation. Back in 1980, the only things that pension plans and endowments were invested in, blue, equities, brown, fixed income bonds. That was it. It was bonds and equities. You can see the progression over the years to 2016, how well diversified these plans are. And the reason for that is because they understand the power of non-correlated diversification. So you have a full range of investment asset classes. You've got foreign equities, emerging markets, private equities, fixed income, and absolute return. The managed futures component would fall into that absolute return component, which is about 14%. We recommend 10 to 15%. Many investors find it really difficult, though, to find these attributes in the marketplace when they're looking at these types of investments. So such things as global diversification, the non-correlation, liquidity, regulation, can they actually give comfort to many investors. Having the ability to go long and short, and transparency. Transparency, in other words, knowing what you have in the portfolio. And the neat part is managed futures actually does deliver all of those attributes on as an alternative. Brief description of managed futures: managers that invest in the futures markets. Some of you might remember the movie Trading Places, a classic, and really dealt with risk and how risky investing in individuals' futures can be. I don't recommend anyone pursue an investment strategy in individual futures. The class that I'm teaching right now has learned directly on how that can be a bad idea. And when you're in an investment simulation like we have in the class, we've had students take a ton of risk, and they've done really badly. And we've had some students take a ton of risk, and they've done really well. Well, why? Because they were rolling the dice. And that's really what that is. If you have no idea what you're doing, I don't recommend you trade individual futures, and I think I've made converts of most of my students from that experience. So managed futures is having a controlled mechanism to trade a whole slew of different markets and doing it on a very controlled basis. I call it conscious risk or controlled risk, knowing that if you're diversifying across many different markets, you can end up controlling your level of exposure and your level of risk. Unlike the SEC, hedge funds can fly under the regulation radar because you don't have to be registered as a hedge fund until you reach 150 million of assets. Under the CFTC, which is the futures equivalent of the SEC, you are required to register federally from day one of managing other people's assets in the future business. So even though our firm is still, somewhat entrepreneurial, we're a growing firm, we've been a federally registered entity since day one, which is very, very different than the equity world that the SEC handles. Today, they're called commodity trade advisors, commodity pool operators. I mention that because I think it's a complete misnomer. When you hear the word commodity, everyone says, oh yeah, pork bellies. Well, ironically, pork bellies don't even exist anymore. They actually trade lean hog, but that's a whole other story. The fact is, commodities conjures up wheat, corn, what else? And maybe oil, maybe gold, right? Those are classic commodities. The commodity markets are so much more. Actually, I will go back in a second. I'll talk a little bit about the diversity in the futures markets in a moment. Let me now talk about the results. Okay, now we can see, this is the classic quilt chart. Many of you may have seen this with your advisor, with your broker, and it looks quite different. There's a lot of colors on it. I simplified it, went with sort of blue shading, except for there's one distinct color there, and that's the green managed futures, okay? And you can see over time, it's very unpredictable. From any of these colors, you can't say, oh, there's one leading asset class. It's different every year. And you can't know when it's going to be different, which leads to one to believe, hey, it makes sense to have exposure to different asset classes, right? You can see in 2008, green's on top. Managed futures killed it in that year. My former employer, John Henry, was up 90% that year. It's unbelievable. He knocked the ball out of the park, to go back to the baseball example. And then it chugged along in 2009. Oh, oops, it was still positive, but it was one of the least performing categories, all right? So while it offered fantastic protection, when the markets all recovered because of the quantitative easing, you had the exposure, but it didn't have the same impact as it did when you really needed it back in 08. You can't read this, I know. You're supposed to see the colors. Don't worry about the numbers so much. We'll show you the numbers in a second. But the 20-year average, managed futures comes in third, first being real estate, US stocks, not surprisingly, what everyone owns. But they typically don't have the exposure to that non-correlated asset class, managed futures, which to us makes complete sense. And then just going down from a 20-year average standpoint, international stocks, hedge funds, there's an average, US bonds, commodities, believe it or not, which is raw commodities like timber and stuff. And guess what? Cash. So I met with a client this morning. They had primarily cash. I'm going, yeah, that's great. You know, if you keep your cash, you won't have much. You're going to lose your purchasing power because of inflation. David mentioned I would talk about inflation. Think about that for a second. $10,000 in 1970 would have bought you a house. $10,000 today won't even buy half a car, right? So if you just keep your money in cash, it's really not doing you any service. So just a quick view. The next slide is the same view, believe it or not, over just 15 years instead of 20, just to keep you on your toes though and keep everyone awake. The white dot is managed futures, and you can see, chugs along, does performs well, had a good 14, had a really good 08, like we said, and US stocks is the large cap stocks is sort of a light, sort of weird blue here, down 37. Look at the cluster here. This is 2016 year to date. And to me, that's one of these, right? Like, what's going to happen next? And no one knows. And so from my perspective, it just makes sense to have that level of diversification going forward because we don't know what's going to happen. And this is just an example of correlation. This happens to be us because we've put our systematic hybrid strategy in and we've done the correlation analysis with the major world indices. And remember, the closer to zero, the better from an investment standpoint. So we're actually quite pleased with our own results from non-correlation standpoint because we're nailing it right across the board, including real estate at only minus 0.1. And in this bull run that we've been in forever, it's buy and hold, it's fantastic, right? Oh, guess what? Everyone's talking about index now. Oh, just buy the index and go home. Even the pension plans are saying, you know what, the index is enough. I throw the orange flag on that one. Because what's going to happen is, this chart here is an example of what they call the drawdowns. Drawdowns being if you're at a peak and you fall off, you don't come back to your peak. You're underwater, so to speak, okay? The S&P, the biggest S&P drawdown was from the crash of 29 to the end of World War II. So 16 years, right? That's a long time to have lost money. Post-depression, imagine if you retired in 1973 and you didn't see your stock or your equity positions come back for 7 years. If the markets crash, we were lucky this time because they injected so much money through quantitative easing and the markets roared back. What if they don't? Because they're out of bullets, what happens if there's another crash? Where does your portfolio stand? How do you feel for 7 to 10 years if we stay in that situation? That exists. That's real. Real estate, 06 to 13. Some of you guys remember that and lived through it. Managed futures, 11 to 13. Most recently, the worst period is most recent. And here we have bonds, 08 to 09. Huh, not bad. Well, that's because bonds are relatively safe. They don't offer the returns that most of these do, but there's still a place for bonds in most investors' portfolios. Just a sample of plan sponsors, endowments, sovereign wealth funds. We've got some really big names here. The smart money is invested in these programs. Just access to managers. They're just different ways you can access managed futures. You can get it directly through the investment firms through a separately managed account. You can go to a private limited partnership. There are a few ETFs available and a few mutual funds as well available to access managed futures. Choosing investments. Would you want to own this investment?
Yes.
Oh, good answer, Corey. Thanks. So $5 later. Yeah, this looks pretty good, right? Everyone's heard it. Your grandfather told you, right? Buy low, sell high. That makes sense, right? You want to own this investment. How many people think they own this investment? Oh, it's soybean meal. And so here's a market we trade, and we did really well in this trade. Did we get in here because we're brilliant? No, not that brilliant. We probably got in just around here, and we probably got out. Did we get out up here? Not that brilliant. We probably got out right here when it crossed that line, okay? Because that's how we trade. That's how our algorithms are designed. Now, here's another great example. Yeah. Is this an investment you'd want to own?
Short.
Oh, who said that? Somebody's been paying attention. Elias is in my class. Fantastic. Extra points. So this market, any guess what this market is?
Oil.
Very good. Paying attention once again. This is crude oil. All right? From March 2015 to February of this year, everyone knows that oil crashed from $100 to $26. Did we short it at $100 because we're brilliant? No, we don't have a better crystal ball. Did we short it at 91? Yes. Why? Because it was a trend down. And when that trend started to form, we said, hey, it's moving down, we should be short. Did we ride it to $26? No, we got out, stopped out here about 33-ish in here, 34, 35, okay? We rode it all the way from 92 to 35. It was a great trade for the portfolio. But the point here, not just to say, hey, the point is we can make money as markets collapse. Very few investment alternatives offer that, okay? And that, to us, is the key, and that ends up why we're able to deliver that non-correlated performance over time. This is just an example of all the markets that we trade, just grouped by sector, so all the different, that's the largest market. The fixed income futures market is the largest market in the world. We trade global markets, the Boone, the Schatz, Bobble, all of that. We trade all the precious metals, gold, copper, palladium, platinum. We trade all the ags. We trade all the energy sector. We trade all the major currencies. Brexit was a wonderful thing for us. God, I love those Brits, eh? Because they decided to leave and we were short the pound. Brilliant. And why? I keep saying brilliant. No, it's not because we're brilliant. We follow the system. We follow the trend into the market. And that's what you try to do as an alternative investment manager. So what's to come? So I sort of make light of the brilliance, but no, it's really about following the market trends. We really have no idea. When was the last time you met an investment manager that said, so what do you think? They have an opinion, right? And you ask me, I don't have an opinion. It's complete contrast to what you're used to. To this day, and John Henry was certainly one of my role models in that regard, to this day he's still the worst interview in the world. Because they'll say, Mr. Henry, you've made a lot of money in the commodity markets, so what's your view of the dollar? And he says, I don't have a view. And so, and he really doesn't. And so the reporter has no idea what to say next. Because you interview a classic portfolio manager and you'll get an answer. Because he's paid a lot of money to have an opinion. At the end of the day, all that is an opinion. For us, we think it's much more prudent to follow markets. So ask yourself, how is your portfolio currently positioned? Do you have that exposure? Get prepared to take a new perspective. Add an investment that is non-correlated. It could be important going forward. Here's an example of market dislocations and how managed futures perform in various sort of situations. We've got Black Monday from '87. We've got the Gulf War, first Gulf War, second Gulf War, Lehman bankruptcy of '08. Just an example of how it performs under crisis. Another view of that, when critical events occur, top blue line is managed futures, orange line is the S&P, just to give you a relative basis of what it looks like. They call it crisis alpha, alpha being a good thing. Won't go into the details there, but that's what they call it because in times of crisis, it often actually performs. So it's a really good thing to have in your portfolio in situations like that. If you wanted to stare very closely at that chart, you'd see that that is indeed the case. Suggested allocation. We're going to go on a limb here and say 60-40 is dead. We think sort of 15 to 20% makes sense. The ultimate result of having a 50-30-20 exposure is going to drive down your overall risk of your portfolio, ultimately potentially increase your return, and very likely decrease your overall drawdown for your portfolio. So the suggested allocation, we suggest take a look, follow sort of Yale's role. It's very unlikely you can be Yale. You don't have the training or the staff, right? But as an individual investor, it's really important to ask yourselves, what should my portfolio, what should my exposure be? We think it's realistic to say, look, 10 to 15% exposure makes sense, okay? And then how to get started? One of the things we offer, just because we are local and we are, an investment manager, we think it would be helpful for investors to say, hey, come to us, we'll do a risk analysis. We'll actually do a correlation analysis on your existing portfolio. Because chances are good your existing advisor and broker hasn't done that for you. They may not want to do it for you if they've recommended this sort of the 60-40 approach, and they may not need to. But if you want to sort of protect yourself going forward, you're going to utilize some of the strategies that David suggested tonight from your trust and asset perspective. If you're looking at the granularity of your portfolio itself, you might want to say, hey, it would make sense for me to have this level of exposure. So if you want, there's still lots of, I see those little shrimp thingies. If you haven't had one, you've got to have one before you leave because they're really good. So we're going to be sticking around for a little while afterwards, and feel free to have yourself another drink. Everyone read this carefully. You must. And I can't go on until you have. It is important and required. And then there's my contact information if you'd like to reach me afterwards. But thank you very much for coming. I know that your time is important, and I really appreciate you being here. So thank you very much.